Hi, I'm Warren Ingram from Galileo Capital, and I'd like to welcome you to the latest in Blue Chips Roundtable Discussion series for financial planners. We're talking about investing offshore and how to structure financial plans to suit each client's needs and objectives. And today's roundtable is sponsored by Momentum Investments. Thank you, Momentum. We appreciate it. I'm obviously not an expert on everything, and certainly my job today is to talk as little as possible and give the exposure to the experts on the call. I'm thrilled to have Joanne Bainham from Sterling Private Wealth, Barry Omani from Veritas Wealth, and Hannes Esterhazy from Momentum Investments. Thanks so much to all of you for joining. And so, Joanne, if you'd like to give us a bit of background in terms of your experience and your expertise.
Thanks, Warren, and thanks for inviting me today. It's a real pleasure. As you said, my name's Joanne Bainham. I'm a wealth manager at Sterling Wealth Managers. I've been there for about 4 or 5 years now. I've been in the industry for over 27 years, starting in Appleton, which is now PSG. I started off in portfolio management and as an analyst and then a portfolio manager. And then I went on to found Miton Optimal, discretionary fund manager in South Africa. And I was the founder and early member there. And I was head of investment strategy on global assets. So global's very much in my blood. I've been doing it for over 15, 20 years. I also work for Asset TV. I'm a moderator on a lot of their panels, so I'm quite familiar with interviewing fund managers. And then I'm also consult to Apollo Multi-Asset Managers Offshore, where I'm part of their investment strategy team, where we discuss global asset allocation. So wealth manager first, but I do have quite a lot of background in asset allocation, particularly on global markets.
Thank you very much for joining us. And Barry, if you'd like to introduce yourself.
Yeah, so my name is Barry Omani from Veritas Wealth in Cape Town. We're an independent financial planning company. We've got 5 CFPs in our business, and when I started the business nearly 20 years ago now, I saw myself as a bit of an investment advisor that did financial planning. But as the years have gone on, I suppose we've learned the hard way that there's probably more value to be added to our clients through financial planning than maybe through the investment side of our business.
Thank you, Barry. And last but by no means least, Hannes.
Warren, thank you very much for the opportunity. My name is Hannes Esterhazy. I've been in the industry now for 20 years. I come from a legal background, and I gradually discovered that I like investments way much more than the legalese and the legal aspects. I've been employed with Momentum for the last approximately 10, 11 years and in various investment roles, and the last 2 years focusing mainly on international investments. So ultimately, assisting advisors to structure investments, to give generic information and answer on products, technical components of products. And yes, that's me. Looking forward to this afternoon's discussion.
Before we kick off, just to note that you will be able to claim half a CPD point for this session. Just go through the normal channels, the normal procedures on the FPI's website. With the formalities out the way, I'd like to kind of just give a context to the conversation. So, I mean, all of us in this industry would be clear that offshore investments are an absolute massive theme in our lives. Whether we're driving the conversation, with clients, or clients driving the conversation with us. Or even, the talking heads in the media, kind of lambasting our clients with bad news all day long about South Africa. We can't get away from the fact that, offshore investments is a significant part of the conversation and will be for probably the decades to come. And so I think it's very often nowadays not a question of whether someone should have money overseas, but potentially how much. And so I thought maybe just to kick off with you, Barry, from a financial planning perspective, what are the reasons that your clients give you as to why they want to invest overseas?
Why my clients want to do it. I mean, much of that is to do with fear, the political fear, the country fear, and the perceived. In both cases, the country perceived risks that are involved in living in South Africa. We often spend quite a lot of time trying to getting them to articulate their views on these issues. And often they're walking in with kind of what's happened lately, you know, whether it's the Ukraine, if it's Gaza, maybe it's what's happening with Taiwan and China and America, and people are getting very nervous and believing that they need to do something about this. What we try to do as a financial planner, and a financial planner is really the general practitioner, if you're relating it to the medical field. What we try and do is just put getting them to understand kind of where does the offshore portion fit into their portfolio over time, rather than let's get every single cent out of South Africa and invest it offshore. And we try slowly and gently to get them to realize that there are also risks when you make such big moves yourself. So what we're trying to do always is trying to get them to understand what do they actually need. What returns do they need to achieve to meet the lifestyles that they want to lead? And then after that, then we discuss the asset allocation. And within the asset allocation, we will then discuss how much of that should be offshore.
And how do you talk them down, Barry, when they're arriving in this heightened state of fear, and it's whether it's elections or NHI or nationalization of the Reserve Bank, there's always a good reason to be fearful, and we all know that's not necessarily a good basis for making investment decisions. But how do you get them from kind of the dog whisperer would have called it the red state, down to kind of a baseline emotional state?
Well, the first thing is to get them to realize that they are actually in an emotional state, that they are actually either nervous or fearful or afraid. And so that, and that's just by staying in the conversation with them, that over time, and kind of maybe even in the meeting pointing out that I can see that you're actually very nervous here, or that you're afraid at the moment, and I can see that you're quite emotional about this. And for many people, that'll be the first time that they think they're coming in being quite logical about it, and they're action orientated at that point. Whereas if you can slow them down by asking some really good questions, and then maybe even point it out to them what you're actually seeing, and reflecting back to them what you're seeing.
And so, Hannes, let's assume we're sitting with a client, and it's now clear that it's time for them to send some money overseas. The inevitable question is, what's the best exchange rate? What are we waiting for? Should we wait for 17.50 or 21.22 to the dollar? How do we kind of look at this and make a rational decision about converting our rands to dollars?
Warren, a very good question. And I think there's two components to that question, or two components to that answer. The first one is get professional help. There's quite a few Forex dealers who will assist clients in I don't want to call it time the market, because that's a bad word to use, but to assist clients in making the right decision at the right time. So that's the first thing. Get the right people on board. And that's a theme that comes up throughout this discussion quite often, that you cannot do it on your own. You need assistance. You need the right experts on board. The second point I want to make is that it's quite interesting that when you go and compare the return of some of the major indices out there, if you look, let's take the S&P 500. Often when you plot that against the performance of the rand, we see an inverse correlation. What I mean by that is, when the rand is weak, often markets, it's often the best time to buy into those indices. In other words, when you wait for the rand to recover and to get strong again, in inverted commas, those markets would have run anyway. And you will anyway end up buying essentially fewer units or the same amount of units since the rand increased, but it would have been the same amount of units that you would have bought when the rand was low. So the conclusion of that is go into the market. Make sure that you get into the market as soon as possible. Ultimately, if you are not in the market, you cannot share in dividends. You cannot share in those short windfalls or those unexpected windfalls. So ultimately, the rand in itself should not be such a strong, or the currency, the exchange rate in itself should not be such a strong driver of your decision as we often see in the market.
Hannes, you say market timing is the worst possible reason to do anything, I guess, and so it's a valid point. I'm reserved a tough question for you, Jan. We are also faced with the question a lot. Shouldn't I not rather just buy euros because the UK is in a mess and I'm not going to buy pounds, and the US is expensive, and could be Trump will be wiping out the world's economy soon. How do you determine what currency to buy when you actually do convert your rands to some kind of international currency?
Well, I think the first thing we do is we find out from the client where they plan to live one day if they're not planning to live in South Africa. So if you live in the UK, then clearly sterling is very important to you. If you live in the States, dollars are important to you, or the Eurozone. But ultimately, when you come to asset classes, the currency is relatively irrelevant from a global equity perspective. It's more important when you're buying cash or you're buying bonds. So you've got to understand sort of where the client sees themselves living, or how does the client think? Is the client a dollar thinker, sterling thinker, a euro thinker? Because ultimately, currencies mean revert. So while you might look very clever this week buying sterling, in 3 months' time, you'll be stupid to hold sterling. You should have rather have held dollars. In fact, the conversation I'm having with clients at the moment is around that all developed market currencies look terrible, and that why are we not holding gold? And I think that's a much more interesting discussion, because in the world we've been living in, where central banks have been pumping liquidity into the global markets, all currencies are literally a race to the bottom. Obviously, South African rand is one of the worst currencies out there, but relative to developed market currencies, none of them have particularly good fundamentals. The dollar at the moment is probably the best of the lot because the stock market there is strong and the economy is strong, and ultimately they can raise interest rates. But the rest of the economies around the world are all looking to cut rates. Yes, the Fed will be the last one to cut, but the dollar will stay stronger for longer. So yeah, like I say, I don't think trying to call euro, sterling, dollar is a huge amount of value add for clients. I really don't, unless they're particularly thinking moving to the UK and then they want a sterling bank account. But other than that, it does come out in the wash.
And so to follow on, you mentioned briefly you would be holding gold.
I've got a number of clients. It's back to what Barry was saying earlier. It's a lot to do with risk tolerance. If you're really worried about keeping the real value of your portfolio going, one has to look at gold at the moment. It's been very interesting. Gold has been going up despite the fact that real rates are very high at the moment. It's because central banks in Asia have noticed that the Americans are spending money like there's no tomorrow. So you've seen a lot of Asian buyers, a lot of Chinese are buying gold. They've been selling their US treasuries. So gold is definitely a currency, inverted commas, that we are looking at, but not for all clients. It's a very specific cohort of clients that will look at gold. For the vast majority of clients, gold is not very interesting for them.
Barry, I'm conscious that you might have a slightly different view.
Yeah, it was something Hannes said, which actually I've as the central person in a person's finances now, if you're their financial advisor, financial planner, we actually got to know a currency guy that did the trading for us. Now, the reason we used him is because he got us much better rates than if we told our clients to go to the bank and just tell the bank to execute. So we were using him to execute at better rates. The longer we used him, it didn't matter what day you phoned him up. He would talk about what the circumstance was in the world at the time. But at the end of the phone call, you knew he was going to, the advice was always going to be, but you probably should just move in it today. So as a financial planner, I think you've just got to decide how you're going to execute this. I think the one financial tool that can absolutely like clean you up and make you look like a complete mug is the rand, and probably any other currency, but obviously the rand moves so massively. So I think you, as the financial planner, need to sit down with the client and say, look, we don't know what's going to happen. This is a very volatile currency, and we are going to implement this over 3 months, 6 months, 2 years, whatever it is. And this is how we're going to do it. But have a plan, and just don't hang around and wait for the moment when the rand is strong and then we're going to go offshore. Because I think it was Hannah said, you're not going to have a strong rand and a weak market at the same time, and a weak developed market at the same time. It's just probably not going to happen.
I always feel I have some farming clients, and they've always told me just to buy, and every time I've told them to possibly wait a bit, they've come out right, because the rand, one thing it does do, and I agree with you, Barry, is it can embarrass you at any time.
Yeah.
Joanne, I want to come back to you quickly, because I'm sitting here and I'm thinking, gold's not a great generator of interest or dividends, and so it's kind of a dead asset until it goes up, and so. The counter argument for holding something that will only go up because other people are more fearful than you are when you bought it. How do you counter that?
Okay, if you look at the S&P since the market's bottomed of April this year, it kind of went had a downdraft and it's come up again. Gold's outperformed the S&P 500. In a world where there's just too much liquidity around, gold is outperforming because it's a fixed asset class in a sense. So you're right, there is no real yield. And most fund managers will tell you they'll never touch gold because they can't value it from a DCF perspective. It is an anti-currency. It is a store of value. And I don't want to get into Bitcoin because I think that's too difficult to discuss. But the reality is, if you have a world where there's just too much money being pumped in, fiscal spending has lost all kind of relevance in terms of what we should be doing, gold is a very good store of value. In the long run, you don't want to hold gold. You absolutely don't. But in the short run, there are definitely times where it makes sense. It's not massively different from saying, I want to be long dollars versus long euros. It is ultimately a currency that you think will have better value. But yes, you're right. There's no dividends, there's no interest, but it's incredible to see how well it's doing. In fact, year to date, gold has hugely outperformed the S&P. So gold's doing very well. Just want to comment on Barry's thing on currencies, though, and back to the financial planning discussion. We can all try and be clever and time the currency. Generally, we're going to get it wrong. The reality is we have a fair value for the rand of what most fund managers tell me is about 1750. We're currently, 1810 or something. If you take out the currency, hypothetically, if it was 21 and fair value was 1750, and you sat in cash, you were taking a big risk for your clients because it could ultimately snap back to 1750. However, it is very true that the rand tends to be a strong currency when other markets are also going up. So if you're in equities or you're in risk assets of some sort, even gold, you can protect your capital even the currency strengthens. So I think it's an asset class argument. Don't take your money offshore and sit in cash if the rand is very weak, because chances are that's going to bite you. But in the long run, if you're looking at 5-10 years, it doesn't really matter. In the short term, it does. The long run, it doesn't. So I hope I answered your question there on gold, Warren. Gold is, it's about a 5% holding in client portfolios. Of the fund managers I interview that I got a huge amount of respect for, they all have about 5% in gold at the moment. It's just some sort of protection in a world where central banks just print too much money.
I want to come to you, Hannah, soon around where do we put our money when we go. But Barry, is there an ideal allocation for clients to go offshore? Is there an ideal proportion? If we're talking about asset allocation, is there an ideal offshore allocation?
I don't know, because every time the Reserve Bank allows, I don't know how long ago when it was a 10% and then it was 15 and then 30 and when suddenly it's 45, and then suddenly every asset manager uses it up to 45%. And now a year later or so, you can sense that it's actually over 50%, that they believe it's over 50. So they're pushing the boundary out further. we kind of come at it differently in that we look at what their liabilities are in South Africa. We look at the we use up when they're saving, so we will let them put the money into whatever they can get a tax deduction in retirement funding, put it into their tax-free savings, which may actually and probably does go primarily offshore. And then we turn and we look at having money available to meet any short-term emergency funds or comfort to have that cash quite close to them in South Africa. And then the wealthier the client is, then we will allow them we would be advising them more and more to take more of that money into a global portfolio. I think maybe the changing mind shift in South Africa ultimately is, and as financial planners, is that actually we should all have probably global portfolios, not South African portfolios and global portfolios. We probably should be looking at having just global portfolios.
Hannes, I want to check in with you because I think you've got some comments around this.
This is the question that we see as the most difficult question for advisors and clients to answer. How much should I take offshore? Now, I think that whole discussion starts off with, in your typical diversified portfolio, yes, you will be somewhere between, let's say, 25 and 60% offshore. But that answer does not really give you an answer. So what we started to see is a trend where there's client-specific reasons becoming all the more important to immigrate. And we're talking about clients who are saying, listen, my children immigrated. I need to protect their inheritance. How much should I invest if I want their inheritance to be protected? How much should I invest offshore, in other words? We see people saying, I want to go and retire offshore with my children in Australia, in Mauritius, wherever. So suddenly that portfolio begins to look different as well.
And Joanne, I think if you had to answer that question about an optimal allocation.
It's funny, I don't see the world as global versus local. I see it much more simplistically and say, what is the perfect asset class mix for my clients? And within those asset class mixes, where do I want to be? I mean, in a perfect world, your MSCI World should be your benchmark for equities. So what slither of that should be the JSE? That's just saying within a global portfolio, how much do you want for local versus offshore? We have this construct in South Africa that we're max at 45% offshore. Why? It makes absolutely no sense. And for discretionary portfolios today, you sit down and it's exactly what Barry was saying. What are your liquidity needs? You know, if you need a lot of cash in the short term, you've got strong cash flow needs, then you can't have a lot of money offshore because the rand will kill you. You can't be taking money from offshore and bringing it back locally every month. You just can't do it. So therefore, you're going to have a bias towards more local assets, fixed income, cash, that sort of thing. But if you're building a legacy portfolio, which is going to live long after you've died, you want to have as higher growth as possible. You have a much stronger exposure to offshore. So there is no simple answer to this. It's where are the asset classes giving you the best returns? And is it at the JSE or is that in global markets? Are SA bonds better than global bonds? There's no simple rule to this. It's what are the client's needs? Now, to Hannes's point, if you're going to immigrate one day, well, then you're probably a global citizen. And I'm telling you now, global citizens don't have 55% in local assets. They just don't. So you've got to look at the client's needs. It's all about the client. What do they want? But clearly, if liquidity is important, offshore is going to be a smaller component because of the currency vagaries. And if the client's thinking about long-term growth, you have much more offshore. But this conversation, offshore versus local, I think we should be saying, what is the asset class mix? And within that, where do we want to be positioned? I think it's much more nuanced than, I want to have 70% offshore. I don't think that's the answer anymore.
I think we're getting to an interesting sort of diversity of views because from a pure financial planner point of view, the jargon would be asset liability management, and I guess you're saying liquidity, Joanne. So we're probably on the same page. And for a lot of our clients, they would almost end up doing it practically. They would say, well, my retirement funds are SA focused, but my discretionary assets, I'll I'll send offshore and then tweak around those margins rather than a very kind of particularly structural view. But I guess you're right. It's about managing cash flows and where cash flows are needed. I want to come to you, Hannes, and one of the things that happened to a lot of us in COVID was naturally we had a lot more people dying, unfortunately, around the world, and one of the things that kind of we all woke up to was this idea of probate around the world. Death duties, the actual process of winding up and investments, and I guess that's not the only reason, but dividends tax, capital gains tax, all of those things become a major issue when we're investing overseas. And so I have two questions for you. One, to kick off, is it not better for me just to get my global exposure through, it used to be called an asset swap, nowadays I guess a feeder fund. Then I'm not worrying about some American tax somewhere that I didn't know about.
That's a very good question. So when you follow the route of asset swap, there are two aspects that you need to bear in mind. Number one, you are not sanitizing the geopolitical risk. In other words, if you're saying I'm concerned about the political situation in South Africa in the long run, then in an asset swap, you are not really taking that risk out of the equation, because your funds will have to come back into rand and it will have to be converted into rands. So although you might benefit from the currency movement in that scenario, you will ultimately not be able to escape geopolitical risk. The next point is a more subtle point, and this relates to how capital gains tax are calculated when you have an asset swap versus hard currency, where there is a functional currency involved. So this calculation, the bottom line of this calculation is that you pay more tax when you do an asset swap as opposed to when you go direct hard currency offshore.
And so if we do go overseas, how do we decide on where the home for the money is? What's the jurisdiction that we choose? Is it one size fits all?
Very good question. So typically in my presentations, I would say, let's look at this facetiously. And we say, on the one hand, you've got America. Oh, everybody wants to invest there. But once you are in that tax net, once you have all their compliance issues on board, it becomes a challenge. On the other hand, you've got places like Afghanistan. Now, we know nobody wants to go there. So in between these two extremes, we have tax havens and international finance centers. So a tax haven, I think we all know what it is. It's a place where you can go and hide your money, and your income will ultimately not be exposed to any taxation. That is something that obviously we do not want you to do as a client. We believe in doing things right. So what's left is international finance centers. So international finance centers are places like Channel Islands. Let's take some of the characteristics that you will see in these jurisdictions. They are typically tax neutral. In other words, you will not be paying more or less tax in those scenarios than in those jurisdictions than you would have paid in South Africa or in your tax residency jurisdiction. They are friendly towards offshore investment. There are a willingness to do business with international investments. Obviously, investing in hard currency, that is the whole purpose of the investment route. Political stability, in other words, looking at how the rating agencies were to rate them, you would typically have a very good rating. So those are the jurisdictions where you want to go. The international finance centers, of course, one jurisdiction might be viewed as an international finance center and by one specific country. Another country may look at the same jurisdiction and say, no, they're fine. So ultimately, you ask yourself, what does the Financial Action Task Force team states on it? FATF, that's the guys who painted us grey last year. And they would typically rate countries and give them a rating using 49 or 49 plus criteria. And many of the Channel Islands, the Crown Dependencies, Guernsey, Jersey, Isle of Man, are highly rated. by these rating organizations. So to answer your question in a nutshell, be on the lookout for an international finance center as opposed to, for example, a tax haven.
Thank you, Hannes. I mean, I think for me, jurisdictions are a critical decision long term. I think you don't want to necessarily be in a place that's super tax efficient today, and they have a coup tomorrow, and all your money disappears. So applying your mind to the right jurisdiction is very important. Barry, I want to come to you because I think jurisdictions is one thing, but we are in a really complex global environment of taxes, and there is a lot to focus on and a lot to be aware of.
Yeah, so this is what's come up for us in the last kind of 5 or so years, and I'm not sure that the product providers are actually providing the financial planners with enough information around the consequences to a global family. So a lot of South Africans are in the south of England. Some are in America, many are in Australia, and those 3 jurisdictions are quite hectic on receiving money from offshore endowments. Now, remember, a South African endowment is an offshore endowment. An endowment that's in Guernsey or one of the Channel Islands is an offshore endowment to them. And when they receive that money can often become income taxable in those people's hands. So many planners think that they have their affairs all organized for their client here, the parents in South Africa. But the consequence for the ultimate beneficiary, the kids of these assets, is not well structured for them, and a lot of thought needs to go in to this. And then it kicks on again, and a lot of people have been building up, on local bank accounts. You have your share portfolio that you can build up yourself, and you can buy your Apple shares, your Magnificent Sevens, and suddenly, the minute you get past $60,000, which my maths isn't great, but that's like just over R1 million, I think. Then suddenly, that money on your death, because they are US listed stocks, are going to get taxed at 40% estate duty in the US. And then lots of South Africans will have bought properties but when they were working there in the UK, they might have inherited money that was over there as well. And once that number goes past £325,000, then you're in for 40% UK estate or inheritance tax, as they call it there. And I mean, this has got so bad and so complicated. One of my colleagues, Claire, has actually qualified as a CFP in London now, and we've built up an association with a company in Kent, and Claire actually is giving advice through their license because of the clients that are either emigrated and gone across there, or kids that are going to inherit money. So we're getting them ready to receive the money on the other side.
Joanne, we sit in a world of, I already feel, overwhelming choice. We're faced with many thousands, tens of thousands of mutual funds around the world, ad exchange traded funds that are accelerating in diversity every single day, and then whether it's gold or crypto products, the diversification increases. It feels to me exponentially, but that's an exaggeration. How on earth do we determine for clients what unit trusts to buy, where to actually put that money?
I love the fact that you say there's so much choice. I've been slightly horrified since I've moved from the asset management world into the wealth management world, how little choice there actually is, particularly on platforms, and that's both local and global. There really isn't much choice at all, particularly if you want to do clever things with ETFs. Half the ETFs aren't even listed on the platforms. So I would argue there's a lot less choice. If you look at South African platforms, it's all the big names that everyone knows about. And on the global platforms that are owned by South African companies, it's all the same names everyone's always heard of. I mean, I guess I'm very lucky because I work for an offshore company and they're regularly interviewing fund managers in London, so we go and see them, we kick the tires. I don't, but they do, and I'm part of the team. But yes, there's an awful lot of choice out there. I think the reality is you don't have to be incredibly complicated with the client's portfolio. The most important thing is asset class movement. So, how much do you have in equities? How much do you have in bonds? So one of the big trades we've been doing this year for clients has been reducing their bond exposure, because I don't think bonds work as a very good diversifying asset class at the moment, particularly in a world where inflation has been higher for longer. So I think get the asset class right. What you do in the building blocks, try and keep it simple. Try to have as much passive as possible because it's really cheap. And then, 1 or 2 active managers, but you don't have to be incredibly complex about it. You don't have to have hundreds of funds. Try to stick to sort of 10 to 15 funds in a portfolio, because remember, they are buying stocks for you. And if you look at it from a top-down perspective, you've got lots of stocks anyway. So try and keep it simple. And I actually don't think there's a huge amount of choice out there. We know the names. They're quite standardized. And we do have the discretionary fund managers in South Africa that are very good at giving advice in this world as to where to buy and what managers are good at what they do. So, yeah, I think you have to partner with a discretionary fund manager that can help in this regard, but there isn't as much choice as you think there is.
I have to follow up then, and if we look at the last decade, it seems to me that the smartest thing to have done with the 2020 hindsight portfolio is just buy the US index and be done with it. Is there any point to worrying about anything else?
I watched a fund manager that being interviewed, and he said, I wish I'd taken my economics textbook and thrown it in the bin because the rules haven't worked. And, it's back to the sort of like, let's look at the currency. Oh, let's hold dollars because the rand has been a terrible currency. The reality is markets move in waves. We've been in a liquidity-led rally for the last 10, 15 years. Developed markets have been strong, emerging markets have struggled. But if you look at it purely from a valuation perspective, there's so much better value now in emerging markets. There's so much better value in currencies like the rand. If you're looking at it from a cyclical perspective, so I think you have to balance it. But no, I wouldn't just buy the S&P 500 and forget about it, though ironically enough, that would have worked. There is a much bigger question, though. If that's all we should be doing, well, then do we need fund managers? Do we need wealth managers? That's a whole new quagmired question. But I think it's all about diversification. And I hate to say this is the one free lunch, right? You diversify across asset classes, across sectors, across geographies, and don't have everything in the US, because at some point, somebody's going to wake up one day and just realize how incredibly expensive that market is.
Barry, I have to jump to you. We're under threat as financial planners now. Joanne's telling us passives are rising everywhere. Is there a need for us to do anything?
Yes. I think passives are rising. I'm just going to jump back just for a second there, just to comment on when we talk about for the last 10 years, all you had to have was the S&P. But if it was 10 or 12 years before that, it's quite amazing how long the investment cycles actually last. Certainly for you as a financial planner and for your clients. And I think it is like 10 or 12 years. And I think we're probably coming to the end of a cycle, potentially, I'm guessing now, completely guessing, with the US. If it's on a PE of 27 at the moment, having a 10-year view going forward is, that looks pretty expensive. And then you look at emerging markets, which we're part of, as Joanne is saying. I mean, we've been beaten up for 3 years in a row, negative returns in those areas. So I do think it is very important to have quite diversified portfolios. I do think that asset management, in fact, asset managers themselves, and they call on us, openly admit that they're in an industry that is probably in decline. They're openly admitting it themselves. It's now appearing that passive isn't like 51% of asset managers won't beat the index. It's probably up at 75% of asset managers won't beat the index. So there's been a clear out of a lot of people that weren't adding a lot of value. And that's why, as a firm, we, as Veritas, haven't chosen to go down the investment side of it. We think we can add a lot more value in helping people to organize their affairs, to understand their affairs, to understand what the money needs to do for them. and then put it in place for them and give them that sense of understanding and sense of control over their affairs.
Hannes, I'm conscious that you're not an investment specialist, but I'm wondering if you have any thoughts on this.
Yes, I've got quite a few thoughts, and I want to go back to where Barry started about the complexities of understanding the tax jurisdictions of your client and then the beneficiaries of those clients. So what we typically see is that many products were built purely with a view to South African investors investing offshore. But what we've seen the last 10 years happen is that it's no longer a question about, are you a South African taxpayer? It becomes a question of, are you a South African taxpayer, tax resident, and a tax resident in an offshore jurisdiction? Because suddenly those questions that Barry raised becomes extremely important. And then the third component, or the third, call it stream, advice stream that we are seeing, is clients who are saying, my beneficiaries have emigrated. I need to plan for them. And what makes it so complex is that, as Barry also mentioned, a lot of jurisdictions are looking extremely negatively at offshore endowments. So on that point, it's important to understand that an endowment is a brilliant solution on many levels, but there's also voluntary products in the market. Not everybody offer those voluntary products, so make sure that your product provider have those voluntary products available. And for many jurisdictions, a voluntary product might be the right way to go. It might even be a good question to ask, should I convert my endowment to a voluntary product? Now, there's a whole range of questions that come into that discussion that we're not going to discuss. But the point is, the complexity of the taxation scenarios becomes sometimes overwhelming, and it means you often need a expat tax expert or someone in that jurisdiction who can assist your client with that. And then on top of that, we've seen how product platforms had to change over the last few years. One of the points that were raised was advice, and or let's rather call it generic information, giving advisors more information, enabling them to make these calls. So it's important to ask yourself, does the product provider that you're dealing with, do they have the infrastructure to give you advice, or not advice, but to give you the information about different jurisdictions, to guide you into advising your clients correctly? And then the second point, how platforms have also transformed in the last few years, the range of funds. Now, obviously, we've got the FSCA saying, and CISCA legislation saying, only FSCA funds may be solicited. So that's a discussion in itself as well. But when you look at a platform, you need to ask yourself, what's their fund range? And in our analysis of platforms, we've seen platforms with 200 or 300 funds, 1,000 plus, 2 or 3 index trackers or exchange traded funds, almost 100. So you need to understand, where do you want to play, on what field do you want to play, because different platforms have different solutions and different fund offerings.
I want to just bounce to Joanne, who has some information for us around tax.
Just saying back to Barry's comment about specializing on the holistic financial planning and what the client's needs and what's their budgets and what's their cash flow. I think the reality is tax has become so incredibly complex that our attitude at Sterling is we'll actually hire people to help. We have to recognize there's a problem. I think that's part of the solution, is knowing a client might have an immigration issue or have children living in different jurisdictions. But I don't think any wealth manager here can say they're an absolute, they know everything about tax planning. So in our opinion, you have to go and hire people to help you with that, but you have to recognize there's a problem. I just want to go back to the question you asked me earlier about, there's so much investment choice. What we have seen, what I've seen in my practice, is a number of clients now looking for custodial accounts within their endowment wrappers because they want to buy more ETFs. They want greater choice. And a lot of the better platforms out there in South Africa at the moment, especially globally, allow you a custodial platform inside your endowment wrapper. So you can then do a lot more for those clients who are looking for a more bespoke solution. I mean, for the vast majority of clients, I just want to come back to this. We're talking about immigration and tax advice, and it's all so complex. And most South Africans, probably the vast majority, when they put their money offshore, it's quite simple. They want a simple solution. They don't have all these tax planning to worry about. And so I think the endowment wrappers or sinking funds that the platforms provide still a very good solution for the vast majority of South Africans. Not everyone has family living everywhere. So I still think the solution works. But for those clients who are looking for something a bit more bespoke, we definitely would encourage you to have a custodial account within your endowment wrapper. It works very nicely.
I think we're going to be running out of time soon, and there's about another 3,000 questions that we could go through, and so I want to ask each of you if you could give somebody your best one piece of advice around this international investment scope. What would be the one thing you would want to tell somebody about international investments, bearing in mind your audience are financial planners, speaking as a financial planner, we're under tremendous pressure all the time to be really clever.
So I'll stay away from investments, and I would say that in your next annual reviews or reviews with your clients, sit down with them, ask them where all the kids are, the adult kids, what their plans are, and if you find that people have drifted and emigrated and look as if they'll probably stay there, then there's quite a bit of work for you to do. Because if there's a trust involved, which we haven't spoken about, but think of a trust as well as an offshore, as an endowment, and if they're in the UK, Australia, and the US, then you've got work to do, and the client is going to see the value add that's coming with it. The other one is if they have got the situs issues of having US based shares, and which pushes them through $60,000, then you've got some work to do. And also, if there is properties in the UK and that property is kind of more than kind of $500,000 or £325,000, you've got work to do. So there's a lot of work out there. It is a value add. These things are changing all of the time, and more jurisdictions are going to follow suit, I think, in time.
Thank you, Barry. Joanne?
I agree with Barry. Intergenerational family planning is unbelievably important, particularly with people living all around the world at the moment. Your question around offshore, I think the most important thing I would be saying to people is, are you looking at capital preservation, or are you looking at growing your returns? So if you want strong growth, or do you want capital preservation? Because we've become so used to just buying equities in our global portfolios. Maybe we've got to start looking at alternative assets, private equity, private debt, etc. I think that it's not as simple just buy global equities when you put your money offshore anymore. It's much more nuanced than that.
Thank you, Joanne. And Hannes?
Warren, I think I'm going to summarize in 4 points. Number one, you need to have offshore exposure. That's point number one, in hard currency. Point number two, it doesn't serve a purpose to do that via asset swap. Well, it does, but ultimately you need hard currency exposure. Number three, it is more complex. There are more challenges. So it's not going to be the same process that you're used to on the local level. But number four, I think it's important to understand that there are a lot of help out there, from approaching expat attorneys or Forex agents to platforms, the legal advisors that platforms often have to offer, the BDMs, investment specialists or product specialists that are there. So don't be scared. You need to do this for your clients.
If I have to summarize from today, I think the key points to take away from me is don't be afraid to get to pay for proper tax advice. Don't be afraid to use good tax expertise when you don't know what's going on. And it's very hard for financial planners to say to a client, I don't know the answer to your question. It's a great question. I don't know the answer. And if that's the case, be brave enough to say that. It doesn't make you look worse. It makes you look infinitely better, especially when you help them potentially avoid major pitfalls later in life or at the end of their lives. And secondly, it's never complicated when you're dealing with human beings, and you can develop a good strategy that suits them. It's always complicated when you try and predict and forecast what's going to happen, and then try and adapt your entire investment process to what might change next week or next in the next hour. I think you have to be very clear that everything's about the client, and get the strategy right for the client, and then life gets a bit easier and a bit simpler. And so on that note, thank you very much for watching. Thank you to Momentum Investments for sponsoring, and to Blue Chip for putting this together. I hope you've enjoyed the session.